All right. So I don't have any slides. I'm just going to refer to my notes a little bit here. And basically, I want to describe a major challenge that I see with the protocol long-term and try to frame the problem a little bit for people to think about it. And then I'll share a, not even half-baked, but like quarter-baked idea for how this could potentially be solved. And maybe that will inspire some other thoughts. So I think it's worth sharing, even though it's like, yeah, literally I sat down and tried to understand this idea out of my own Google Doc, and I 75% understand even my own idea from 6 months ago. So, but I think it'll be a good prompt. Brandon, I'm especially interested in your opinion, since this is a topic that you've thought about. For folks who don't know, Brandon is one of the co-founders of Ampleforth, and they've built the spot mechanism to create a flat coin. Basically, I think it's like CPI-pegged flat coin. That uses a cool mechanism that's sort of spiritually related to the thing I'm going to talk about. So, okay, so high level, as we talked about a little bit yesterday, there's this question of, are there assets in the world that are stable enough to just bundle them together, maybe with some active management but no hedging, and use that as money? And I kind of think the answer might be no, because if we look at these asset histories, like Taylor walked us through yesterday, the other Taylor walked us through yesterday, there's just these really high max drawdown numbers that you have to worry about. And I'm just not sure what the best way is to handle that, but it seems to me like one direction that's very worth exploring is, can you create some sort of hedging structure where some population is getting stability and trading off some upside, and some other investor population is getting that extra upside and leverage in exchange for absorbing volatility, right? So in particular, let's see, how do I want to put this? We could kind of piggyback off of the hypothetical example of just making an R token that's based on the S&P 500 as collateral, and say okay, we think that the S&P 500 is solid in terms of a long-term investment, generally goes up, but too high of a max drawdown to tolerate for use as money. So can you take that asset portfolio and then add some sort of hedging on top of it in order to create something that would be basically a tolerable structured product flat coin? So let me walk through this idea and see what you guys think about it. This is basically trying to make a relatively small change, or somewhat large, but medium change to the way that the protocol works, to take advantage of the staking mechanism, the RSR staking mechanism, in order to provide a backstop and reduce volatility. In particular, the way that I would characterize this on a high level, before we even talk about any details of the idea, is it seems like with a crypto mechanism, you want there to be some existing collateral that's available on-chain in order to know where is this extra capital that would cover you if you have this downside, right? So if you have some sort of contract, some sort of I think you would call it a swap agreement, maybe that's a misuse of the term, where okay, if the S&P 500, goes down more than X%, then okay, that's no longer tolerable, that drawdown is no longer tolerable for our currency users. So whatever the remaining loss has to be covered by some other investor population. Well, where's that capital going to come from to cover that loss? You wouldn't want a system where it's oh, we just hope that they show up and deposit the capital into the smart contract in order to cover things. No, you want the capital to be there. And so basically you want this to be some sort of collateralized arrangement where this excess collateral is sitting there available to be seized in the event that it's needed. Sounds quite a bit like staked RSR, which is all just sitting there in order to be seized in the event that it's needed. It's just that we're redefining sort of what default means, right? So in the current system, a default means a dislocation between some collateral asset in the basket and some off-chain asset that it's supposed to be pegged to, or some collateral asset and some on-chain asset that it's meant to be tied to, like CUSDC and USDC, right? If Compound has an issue, and we see a dislocation, that's treated as a default. Here, I'm just saying, what if we redefine the notion of default in some sense to be just a depreciation in value terms? I'll get to that, how we define that in a moment. If that goes down too much in purchasing power, the underlying basket, then maybe we call that a default, and we call on the seized RSR capital to make up for that difference. So let's try to define that threshold a little bit better. So if the thing that we're trying to produce is a flat coin, then the thing that we care about is the value of this underlying portfolio in consumer baskets is sort of the way I think about it, right? So if you have some definition of a consumer basket that's sort of like what is used to calculate CPI, because it's not that we care about the value of these assets in dollar terms. The dollar could be all over the place. It could hyperinflate, or it could moon, or whatever. We don't want to care about the dollar. We want to care about the purchasing power of this underlying portfolio that's here to back the currency. So when I say consumer baskets, it's like you take the value of that collateral in terms of how much it could purchase of some consumer basket, in terms of rent and cars and gas and cereal and whatever, where probably the way that you actually logistically do this, but I think this is something that Ampleforth has actually had to think through, so I'm curious about your take on it, is you price it in dollars, you have a price feed of this portfolio in dollars, and then you have some conversion between dollars and CPI, whatever, to get to consumer baskets. So it's a two-stage pricing mechanism. The idea is that you have some lag in how often you calculate CPI or whatever sort of pricing method that you're using there, and I'm not quite sure how we would deal with that. But if you sort of abstract that away and you imagine that you have a perfect valuation or perfect sort of data feed for CPI at all times, then no matter if the dollar goes all over the place, you don't really care, because the dollar is just an intermediate step. You're getting the value of this thing in dollars because that's what it's traded against, and you're converting to the value in consumer baskets. Before I go into the next step, does anybody have a question about what I mean by consumer baskets and valuing the thing in consumer baskets? Does that make sense? Cool. So that's a necessary building block, because the way that I'm thinking about this, you would structure basically the kind of contract between the flat coin holders and, in this case, the RSR stakers, not in terms of any sort of dollar-based contract, but it's a consumer baskets-based contract, where basically, as you'll see in a moment when I walk through the mechanism, if, like I said, if the value of that underlying portfolio depreciates too much in consumer basket terms, that's what would trigger the RSR staked capital to be taken in and sold in order to boost the value of the backing. So, let's see how to explain this. So, okay, with that high-level explanation in mind, let me talk about some mechanistic details of how this could possibly work. So, you have RSR staked, much like we have today. I imagine, in these details, it's I don't even remember the exact rationale for why I came up with these details 6 months ago when I was thinking about this, but you can imagine a version where the RSR can be locked for up to, say, 5 years, and the longer you lock, the more of a boost it provides you, and I'll explain what a boost is in a second. Actually, I think I do know the motivation for that. It's basically if you're relying on this pool of capital to be your backstop collateral, a 2-week lockup like we have with staked RSR today is not really very comforting. You want to know, okay, we have all this S&P 500 as our main backing, and then we have all this other collateral that's locked for varying different rates, but some of it up to 5 years. So there's this huge amount of collateral that's there to cover the system in the event of a depreciation in consumer basket terms of the S&P 500 backing. Okay, so the way that you incentivize stakers to lock for longer is that instead of taking revenue, and I'll define where revenue comes from in a moment because it's a little bit different from the current system. So just for now, assume by magic that there's some income stream. instead of taking revenue and just handing it, dividing it up and handing it directly to the stakers, instead you have what I'm going to call a reward table. Okay, so the reward table is basically just a division of who has rights to what amount of the revenue stream. Okay, and let's assume that this reward table is tokenized, so it's represented with the reward token. Okay, but the reward token behaves in a slightly strange way, where every month the reward token balances are rebased down by 1%, and then 1% of new issuance is created and awarded to the current stakers pro rata. Let you think about that for a second.
Could you say that again?
Yeah, so every month, the reward token balances are rebased down by 1%. So if you had 100 reward tokens, you now have 99 reward tokens. And then 1%, that 1% is basically reissued pro rata to whoever is currently staking. And so what that means is if you've staked for a long time and you have, 1% of the reward token supply, and then you unstake, you don't immediately get cut out of the cap table, so to speak, or the reward table. Instead, that happens incrementally, sort of 1% at a time over the course of a long period of time. And obviously these numbers I'm just pulling out of thin air. It could be different numbers or whatever, but the idea is that there's this sort of payoff matrix or this reward table, this reward token, and by staking, you get more of it. And sort of the longer you stake, you sort of earn more and more of the reward table. If in a steady state, where let's say all of us had staked right at the beginning, and then nobody ever unstakes, and nobody new ever stakes, we would just have the same share of the reward table as we sort of would have with the current RSR payout mechanism. But if some new person came in, it would take them a while to sort of catch up and get their share of the reward table. And if some of us left, it would take a while for our share of the reward table to go away. I honestly forget exactly why I proposed the reward table concept, but that's how this mechanism works. So maybe we'll figure it out. So any questions on that?
So you use the word reward table, which to me kind of implies like that each staker is like kind of in some kind of non-fungible position. But you also mentioned the word token a lot, so I'm just wondering if like...
That's a good question. That's a good question. I think I was imagining this as a non-transferable position, but it could be that it would be fine to transfer it. Yeah, it could be that it'd be fine to transfer it. And then one thing I wanted to, actually I forgot to say is, it's the new reward tokens are issued pro rata with boosts, okay? And that's an important that's an important part of this mechanism, is that it incentivizes you to not only stake, but to lock for a longer period of time, because the longer you lock for, the more aggressively you get tokens in the reward table, okay? So it means that if all of us have the same amount of RSR, and we all stake right at the beginning, but I lock for 5 years and everybody else locks for less, I end up with more of the reward table because I'm basically locking up my capital and promising to provide that backstop for a longer period of time. Okay? Okay, so then let's first talk about sort of where revenue comes from. So imagine that this S&P 500 backing, as long as markets continue to work the way they have for the recent past, in general will appreciate in consumer basket terms. At like what % per year in like real terms?
In real,
yeah,
4% for global stocks, 6% for US stocks.
Okay, so let's say 6% then in real terms if we're using S&P 500. And so until there's, I'm just gonna again pull a number out of thin air, until there's a 10% surplus in that backing value relative to the sort of liabilities of the system in the sense of, okay, let's use concrete numbers. We'll use small numbers, so let's say that there's like, 100 $2024 or 100 R tokens Let's just say they're all worth $1 to start off with in current terms. And so there's $100 of that S&P 500 backing. Until that appreciates, and let's say nobody mints and redeems our tokens yet, until that appreciates to be worth $110, nothing happens. Or 110 could really be consumer baskets is how we would measure this, not dollars. Sorry for all the confusion there, but the point is that you need to get more than 10% surplus of sort of the value of the backing relative to the value of the outstanding R tokens before you start to count anything as revenue, okay? But it's a little bit like a fund high watermark or something, where once you get past that 10% threshold, now if you have 111% of the value in your backing relative to the value that the R tokens are meant to represent, which remember is defined in consumer basket terms, like each R token is like one consumer basket, not one US dollar. Once you have excess, then you're like, cool, that excess is revenue. We no longer need to keep that on hand as a buffer. We're gonna pay that out to the recipients of revenue, which in this case would be to the reward table, okay? Does that make sense? So once you exceed that threshold, revenue starts to flow to the reward table.
You're smoothing out the slash. You're, right?
What does slashing mean in this context?
Well, I'm sorry, I'm probably thinking ahead, but when you go negative,
Yeah.
your CPI in your consumer assets.
We'll get there. We'll get there. We'll get there. But does the positive case make sense? So basically, we got to the point where we had 111%. So we start to distribute to the reward table. If S&P 500 keeps growing, we just keep distributing the excess to the reward table. We keep that 10% buffer on hand of value. If it drops for a while, but we still have, say, 103% because it dropped less than 10% total, cool, nothing happens. Maybe it starts appreciating again. Eventually it gets above that 10% buffer. We start distributing to the reward table. Then there's the question of what happens if it goes below 100%, okay? So let me actually remind myself if there's any details here. Pretty much, there are details. Okay, this is actually borrowed from the Basis protocol. So if there's a backing deficit, then the staked RSR is seized and it's auctioned off to buy more S&P 500 to get back to 100%. But there's a little bit of a difference to difference between this and how it currently works in the reserve protocol. Right now, the RSR just gets seized, and that's the end of the story for the RSR stakers. Your RSR is just gone. And it's like, all right, this was the moment where you had to cover things. You did, good job, end of story. In this proposal, instead of just seizing the capital, it is instead structured as a forced sale of bonds. So we seize the capital, but we issue you a bond when we seize it. So we're not just taking the money as like sort of an insurance payout. We're instead sort of forcing you to buy a bond with your collateral that's on hand. Why do we do that? Because in this situation, because basically the idea is that, okay, let me actually step back and explain my motivation for this mechanism because, again, maybe the mechanism doesn't make sense, but maybe someone else can turn the motivation into a good mechanism. I thought of the bond idea because I'm trying to create the most attractive sort of deal for the stakers by basically allowing them to get leverage on an appreciating, like generally long-term appreciating asset like the S&P 500, but with the property that they have to deal with downward volatility, but they don't get like zeroed out in their position in the way that you can with some leveraged positions, where if you go leverage long and then the market moves against you, maybe money goes all the way to zero and then you're just out of the market, like Taylor Pearson was talking about. It's like, if you lose too much capital, then no matter what happens later in the market, you've lost all your capital or most of your capital, and so you don't benefit from that. I'm trying to protect the RSR stakers against that in this arrangement. And the way that I'm proposing to do that is, it's like, okay, yes, we took your capital, but we gave you these bonds. And what the bonds do is they make it so that if the portfolio bounces back eventually, and eventually climbs to new highs, we pay off bondholders first before we start paying to the reward table again. And so the idea there is that if there's a crash and you cover it, okay, yes, we took your money away, but before we start compensating future sort of capital providers, we're going to pay you back so that you get back to the position you were at before we took your capital, basically. And then you can resume your upward trajectory of growing your position. So it's meant to be like a leveraged long position that just doesn't have this risk of getting vaporized and going to zero. This is contingent on an assumption that the R token continues to be in use and continues to be big. Because if this happens and your capital is seized and then all the R token holders redeem, well then obviously there's never going to be any revenue to repay your bonds. So, but the idea is that if this is a really big thing that's used as a currency at scale, then you would have you'd have a lot of momentum, you'd have a lot of users, and as long as the R token holders trust that the system is working and this particular currency keeps being in use, then the overall portfolio size of the sort of R token holders stays the same, and eventually that capital does end up appreciating if markets generally go up, and so your bonds get paid back, and then once all the bonds are paid back, then the system starts paying out the reward table again. Many hands. Let's start with Sean.
I was like, in this situation, it's stakers are having their capital seized. Their capital is going to also be RSR. So there's also an assumption that the RSR is not correlated with the underlying basket.
That's true. Yeah.
Okay.
I mean, it could be somewhat correlated. It just can't be it's if the S&P goes down 30% and the staked RSR goes down 30%, well, you still have all that extra capital, it's just 30% less. But it's true. You could do this where the staked capital is tokenized gold or something else as well.
Why would a new RSR staker come in while there were bonds out?
I think I thought about that. Give me a second. You're saying that as a general fact, or in this system, do they have an interest rate?
Yeah, imagine it's a configurable variable. You say times are great, interest rate's 1%. We're not even expecting it to go down. But now it does. And you're like, we need new capital. Each increase the interest rate, you're going to draw on new capital.
So I think I have an answer that actually touches on both of these things, which is that if it's so while you are receiving bonds, you're also continuing to earn reward table tokens. So if there are fewer stakers, you're earning a larger and larger share of the reward table, which again sort of lasts for a while.
You were saying if I'm a new staker, I don't get any share of the reward table until the bonds are paid back.
That's true.
So why would I not just wait until you were done paying back the bonds?
That's a pretty good question.
And if so, why not just forget the bonds thing and freeze staking until it's paid off?
Let me think about that for a second.
Interesting. Keep it low most of the time, you check.
I mean, in a way, there's already a market mechanism for that, where it's okay, let's say that all of the prior staked RSR gets cleared out, and there's just a bunch of bonds, and so it's well, damn, this is a crazy situation. I have to wait for all these bonds to get paid back. Well, if you're the only one who stake, you earn the entire reward table immediately. Once the bonds are paid, I mean, you earn it.
The original stakers, why aren't they back in? Why aren't they selling?
Okay, no, that's true. You don't earn it immediately, but you're the only one earning and getting it from the prior stakers. So the point is just that, like, there's some incentive to stake if you, yeah, I guess the way that it plays out is if you think that we're close enough to the point where funds go to the reward table, you start wanting that reward table. But there could be enough of a gap with the bond queue that you could decide, it's too far and you might not stake. Okay, I take that criticism.
Do I get to progress through the share of the reward table I get, even though I'm not getting rewards? Thanks to the fact that I decided to stake?
Yes, exactly. I mean, that is the idea with the mechanism, but it still might not be enough of a incentive. So what do you mean by adding an interest rate?
So say it's 0 when the market is going sideways. It starts to go down, market. So now we're issuing these bonds, right? And so nobody wants to stake it. But if you say, all right, all those bonds now are paying 1%. People are like, 1%, that's not okay. Now you raise it up to 2, now it's 3, now 4. It's going to take longer to pay off, but you're buying a bond with the return. You're willing to put your money in, and it immediately goes into a bond.
But why would that incentivize people to stake?
You're doing it for the bond.
It's essentially like creating a stability fund, so it just keeps the rate would keep increasing until you have folks who are willing to contribute the capital. It's like,
Right.
what is the clearing rate to provide stability to
So
the
you're saying
currency?
if I stake in after this happens, this is another way, I'm gonna phrase it a different way, tell me if I've got the idea. I'm putting in RSR. That RSR, not just the earnings, but that RSR also gets used to pay back the bonds quicker.
Yeah.
But I also accumulate some kind of extra interest for doing that.
Right, because that immediately goes into a bond. You're just buying a bond.
So you're saying
You're covering like the federal deficit by buying bonds.
you're saying new stakers would be buying bonds?
Because the market's going down, right? So there's a glut, or there's a need for capital to cover the costs.
In theory, all stakers are
RSR is
buying
coming in.
bonds.
If I put in RSR is coming in. The other way RSR could come in is through the auction on income. So there's like two mechanisms for RSR to come in. So during this period, reward people for extra for putting RSR in directly.
Yeah, while it's going
Is that bond rate, is that something that can be determined like algorithmically, or does it need to be set by people?
I'm sorry, I'm still missing it. So the bond interest rates, are you saying interest on outstanding bonds goes up, or you sell new bonds with a higher interest rate?
See, that's the other thing. I don't know if it's like a tiered system. So you say like these, and then you keep increasing, but it's new bond issuance, almost like a raising money for a deficit or something like
Yeah.
that. So I don't know, but I think it would have to be on a per transaction or per LP position
Yeah.
basis.
When you
Okay.
described the, how the income gets paid, you
Yeah.
talked about it going out according to the table.
Mm-hmm.
Is it coming back in the way it happens today, where there's now just there's more RSR in the staking pool, and so when I unstake, I get more, and this is just how much more I get based on my particular share of the income table, or are you actually paying me out in some other wallet somewhere?
It could be either way. I didn't really think about that, but I think it could be either way.
Do I keep getting paid if I unstake?
Yes, proportional to your reward table token holdings. Yeah.
There's a lot of complexity here that I need to get my head around.
Yeah. Anyway, thank you for peering into this strange idea. Any other comments or angles? Like, any other ideas for a just different and better way to do the thing that I'm talking about?
I just mentioned some prior art that might be interesting. They started in Asia maybe 18 years ago, and it's kind of broadened. It's a type of structured product. It was basically we had this very low yield environment. It was basically marketed by banks to retirees, and they were looking for yield. And the pitch was basically the way it was marketed was like, we're going to pay you 6% a year, and like we're generate this yield, but you take this risk that if the market falls more than some percent, say 40%, you get kicked back in. And it's basically what the banks were doing on the back end was they were selling options, right? So just imagine When you're paying for an option, you're paying, a big part of that cost is the implied volatility of the option. So, imagine a scenario where the S&P starts at 100, ends at 100, but, over that path, there's options with implied volatility pricing. You can sell those options to depending on what the price of the option is to generate a yield. The challenge with doing it the way they did it is if you're promising a fixed yield, say 5%, 6%, whatever, the options markets are going up and down. So if they go down, you have to sell more and more volatility to generate that yield, which enhances the chance of you getting kicked back in. So I don't know how you do it. Like, you could make it stable within a certain band, but once you got outside of that band, then it kicks in. So you get no volatility and then a lot of volatility.
Yeah.
If it gets outside of that band.
Yeah.
I don't know how you could do it without.
Do you know what that product was called or is called?
It's sort of like Asian structured products.
Okay.
They're big in Japan and Korea, like selling to grandmas in Japan and Korea was honestly the market. So yeah, they weren't marketed very ethically, in my opinion. But anyway, if you didn't promise a fixed yield and you were being very thoughtful about how you were selling the volatility, right, and that yield scaled up and down with what's sort of available in the market, like, there are ways to run that strategy.
Yeah. Cool.
What do you think about like the nature, the putting a mechanism in that's similar to the backup collateral today? So that like if the S&P 500 is experiencing a problem, instead of just buying more and more of it, maybe you don't in default sell it, but maybe you do have backup collateral defined by the governance that would bring in other investments as the way of trying to flat coin?
Yeah.
Because, my experience of what my investment advisors tell me is, now it's time to get into bonds, now it's time to be in the market kind of stuff.
Yeah, it's an interesting idea, like whether you could predefine a trading strategy that would do better than just buying more of whatever is tanking. Which, I mean, maybe that would not go well, maybe that would go well. I don't know, you're just like, it's like the opposite of momentum, I guess. You're buying while it's going down rather than while it's going up, so. Okay, any last ideas or thoughts? All right. Oh.
I think if I understood the back, there's essentially your active boundary, right? 10%? No?
Yeah.
Yeah. Okay. So when there's supply growth of the Arctic, you actually have an additional burden of growth introduced now.
It's true. Yeah. Yep, that's right. And so actually growth in the R token continually puts off revenue being paid, but it does increase the promise of the size of the revenue once it gets paid. A little bit confusing. Yeah. Okay. All right. Sweet. Thanks.